Hi, I'm Bob Icino, and today I want to talk about the maker-taker model, which is basically an exchange or trading platform pricing system that rewards any market participant, providing liquidity with transaction rebates or money, basically, and charges transaction fees, which is also money, to clients who take liquidity out of the market. Those are the takers. The ones who make liquidity are the makers. The ones who take liquidity out are the takers. It's another one of those market or financial terms that sounds complicated, but is actually super simple to understand. Firms and traders that provide greater market depth by posting buy and sell offers and bids are paid a fee, typically between 20 and 30 cents for every 100 shares traded, but that's not a rule. It varies quite a bit. Firms and clients that take those shares off the market by buying or selling them against the existing order book are charged a fee in the maker-taker model. A maker in the maker-taker model is not to be confused with the official role of a market maker. Market makers are exchange member firms. They're composed of individual dealers that commit firm capital to compete for order flow in particular stocks. That's a market maker. A maker can be anyone. So can a taker. Could be you. So let's make a comparison to make it more clear by comparing maker-taker versus a customer priority model. Prior to the late 1900s, the traditional customer priority model was the dominant model in place. The customer priority model, basically exactly as the words say, was the model that focused on giving client accounts and order flow priority and execution without the necessity of charging exchange fees. Instead, the exchange charged market maker fees for the order execution and collected payment in exchange for that order flow. These order flow payments were then distributed to traditional brokerage firms to attract that flow to the given exchange. Now, the shift from the customer priority to the maker-taker model happened in that late 1990s period. The market started to move away from the customer priority model, again in the late 90s, toward the new model favoring liquidity makers. This new maker-taker model prioritized producing liquidity almost organically. Under this model, individuals that provided order flow that increased market depth and liquidity using resting orders were rewarded by receiving rebates based on the number of shares executed against those resting orders. The other way of saying it is that individuals that utilized orders that reduced liquidities, the market takers, were penalized through the introduction of taker fees that were slightly higher than the maker fees. The weighting of the fees in favor of the makers versus the takers was designed to increase the depth of markets and narrow those bid-offer spreads. By the mid-2000s, the maker-taker model became the primary order flow methodology due to these big rebates. They were profitable and they were popular, and they were provided to the higher volume traders and firms, which made them like this model. The maker-taker model recently has come under closer scrutinization, since the model incentivizes brokers to act against the interest of traders and investors by routing orders for maximum fees rather than the best possible execution. Studies by University of Notre Dame finance professors Shane Corwin and Robert Battaglio and by Indiana University professor Robert Jennings both found stockbrokers regularly channeled client orders to markets providing the best payment, which yielded worse results than if the brokers hadn't considered the payments. In the United States, the Securities and Exchange Commission began to explore the role that the maker-taker fees were having on the execution of order flow, and a pilot program launched in 2018 to formally study the effects of this on the stock market is yet to be fully reviewed. This has brought about popping up of inverted maker-taker models, which would be called taker-makers. But we're going to discuss that in a future video. We're not going to discuss that here. Right now, the point of this video to get you to understand the maker-taker structure and what a maker is and what a taker is, and if you're potentially leaving money on the table because one of those fits you and you could be getting rebates if you had the correct agency broker. Thanks for watching today. If you want to see more videos like this, please like this video and subscribe to the YouTube channel.